Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday everyone. First of all, thank you everybody for your patience with me these last few days and your kind words of support. There is simply too much going on in China and many viewers rely on these videos, so I try hard to maintain daily updates and avoid skipping days, and I hope to continue doing that going forward. At any rate, let's begin with today's episode. The most important developments on the ground in China currently, of course, are related to the massive and messy COVID wave washing across the country. Yesterday we had a big video on this topic, so for today let's shift focus to major economic developments, returning to COVID and reopening tomorrow. And first up for the economy, the Washington-based World Bank has cut its China growth outlook for this year and for 2023. Citing the housing sector and the sudden and messy loosening of zero COVID. In the report, which was published yesterday, Tuesday, the lender forecasts that it expects China's economy to grow 2.7% in 2022, lifting to 4.3% in 2023. 4.3% would represent a recovery, but a disappointing one. Analysts anticipate that Beijing will set a growth rate target of around 5%. Quote, China's growth outlook is subject to significant risks stemming from the uncertain trajectory of the pandemic, of how policies evolve in response to the COVID-19 situation, and the behavioral responses of households and businesses. Persistent stress in the real estate sector could have wider macroeconomic and financial spillovers. End quote. We will be discussing the 2023 outlook later in the video. Some viewers looking at this World Bank report may be asking, with everything China went through in 2022, how the hell did it grow at all? Disruptions and lockdowns caused by zero COVID were certainly devastating to the Chinese economy this year. However, as we anticipated throughout the year, local governments, through standard operating procedure, filled the gaps left by retreating of the private sector with debt-financed public spending on fixed asset investment, mostly infrastructure. We could see this month after month in official and unofficial data as retail spending and private sector investment declined, with fixed asset investment driven by public spending going up. Of course, this isn't very healthy, just as maintaining caloric levels by switching good foods with bad foods isn't very healthy, and can only ever be a temporary solution. As we have seen, household demand, for example, is especially in a bad way this year. In addition, as we've discussed in previous videos, it is likely that much of this investment was in low or non-productive assets, and as such has merely increased the total debt burden on the economy. A short-term fix, but adding to a long-term problem, and a story for future videos. Next up, based on China bond and Shanghai clearinghouse data, analysts have observed this week that managers of domestic mutual funds and wealth management products offloaded 1.3 trillion RMB, approximately $186 billion of bonds from the interbank market in November, the most on record. Bloomberg's Hong Kong team writes that the outflow is nearly twice the size of global fund sales of China bonds so far this year, and, quote, shows the rising influence of individual investors in the nation's debt market. China bonds have been caught in a downward spiral since November as the nation started easing its strict COVID rules, a move that was exacerbated by an exodus of retail investors from funds including wealth management products. End quote. Analysts warn that this market shock is likely to continue as Q1 is expected to see a spike in wealth management product maturities. Domestic financial products held 35.7 trillion RMB of Chinese bonds at the end of November, about 28% of the total interbank market. Next up, relatively reliable data on China's postal and delivery companies gives us an idea of how this COVID wave is disrupting logistics and inflicting temporary labor shortages. According to data provided by the Ministry of Transport, both orders taken and delivered by China's postal and delivery firms both dropped to their lowest points since the end of November. The disruptions, like reopening, have been sudden. On Sunday, delivery firms received 262 million parcels and delivered 282 million, down 8.1% and 6% respectively, from just a day earlier. Chinese financial media outlet Yitai writes that major logistics companies, including JD Logistics Inc. and STO Express Co. Limited, have blamed COVID for hitting their workforce, but do anticipate logistics disruptions to be temporary. Next up, once again, we look forward to the economy in 2023. Hey guys, if you're enjoying the video, don't forget to hit that like button. It's also a huge help if you haven't subscribed yet to maybe consider subscribing. Hit that bell notification and you'll have the most up-to-date analysis on China when I release them. And as always, anyone who can go that extra mile and help me keep China Update sustainable and primarily subscriber supported, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much everybody for the ongoing support. Yesterday we discussed how once China moves through the crises of the first few COVID waves and opens up, 2023 could see a good year of temporary growth. On balance, analysts do believe this to be the case, assuming Beijing does not mismanage both the opening as well as, and especially, the property sector again. Like we said yesterday, COVID management, economic policy, and regulatory policy are aligning in a pro-growth fashion for 2023 for the first time in 3 years. There are already some signals of the anticipated pop in pent-up demand. For example, Civil Aviation Administration of China recently published a passenger flights timetable plan suggesting that the National Civil Aviation Regulator anticipates that domestic flights in China may rebound over the Lunar New Year holidays to hit something just shy of 90% of pre-pandemic levels by the end of January. Anecdotally too, there seems to be growing business confidence. Quote, "But the pessimism right now is only short-term. I believe that in a month or two, the travel market in popular holiday destination Hainan will resume its hustle and bustle seen in the old days." End quote. Despite all this, however, there remain some contrarian views who counsel caution. We already touched on the World Bank's 2023 forecast of 4.3% growth, which would be a disappointment, especially after a low 2022 base year. But some actors in the private sector are cautious too. In an interview over the weekend, the manager of the Wanjia Macro Zesi Multi-Strategy Flexible Allocation Fund, China's best performing mutual fund, said that they believe recovery may remain weak in 2023, and as such, plan on sticking to value stocks. The fund, which as of Monday this week saw 57% year-to-date returns, is thus much less optimistic than most of their peers in the competitive industry. Quote, "The recent rally suggests expectations have gotten ahead of reality." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. I will see you all tomorrow.